if you own a 60-40 portfolio, you need to take part of your 40% that's allocated to bonds and you need to put it in Bitcoin. I am arguing to take money out of fixed income and put it into Bitcoin. And it's for that reason that I wrote my paper titled, Why Every Fixed Income Portfolio Manager in the World Needs to Own Bitcoin as Portfolio Insurance. I calculate the value of Bitcoin using credit default swaps and all that exciting stuff. But the reality is fiat debasement, again, is a certainty.
In the world of Bitcoin, crypto, and investing, Greg Foss applies his expertise in valuing Bitcoin's upcoming price shift in the last part of 2023. As someone who appreciates the mathematics behind credit markets, Foss calculates the value of Bitcoin relative to other financial instruments, aiming to determine whether Bitcoin is overvalued or undervalued. Utilizing a valuation methodology based on credit default swap spreads, Foss arrives at a current value of over $250,000 per Bitcoin. However, he emphasizes that this value is dynamic, as market spreads continue to fluctuate and Bitcoin's price rises. Foss says he envisions a binary outcome for Bitcoin's future, where it reaches a target of $2 million per Bitcoin, and when we can expect this climb in price. When applying probability-adjusted analysis, Foss concludes that Bitcoin is cheap at its current trading price of $30,000. But he maintains that even at a higher price of $100,000, Bitcoin remains an extremely attractive investment in the coming months, due to its potential as a hedge against fiat debasement and the Bitcoin halving that's right around the corner. Let's get right into the latest interview with Greg Foss, as he discusses the future of Bitcoin, investing, and the dynamic world of crypto in the last part of the year. Don't forget to share your thoughts and comments down below, and leave a like if you enjoy the content we do here.
In the world today, total global financial assets are 900 trillion US dollars, of which 400 trillion is global debt. That includes all government debt, but it also includes all corporate debt, real estate, funding, mortgages, etc. But the total of 900 trillion, 400 trillion of it is global debt. So let's play a game. What would be an average coupon we could put on that debt with a high degree of likelihood that the blended average or the weighted average was higher than that coupon? Because that's what debt is. It's a contractual obligation. You don't not pay your debt. If you do not pay your interest coupon, you default. It's classified as a default. You've broken that contract. So US 10-year treasuries are 3.75%. And I'm going to put a global coupon on 400 trillion of a 3% coupon. Now here's the kicker. That 400 trillion is actually 4 times the size of global GDP, which is your tax base, right? So if you have $400 trillion of debt and a $100 trillion global economy, and this debt has a coupon, and I just threw out a low coupon of 3%, that means your numerator is growing at 4 times your denominator, which is your tax base, 4 times an average coupon, 12%. 4 times 3, 12% annually. Is it likely, Jake, that global GDP will grow at 12% annually just to keep pace with the organic, not deficit spending, just organic growth of this numerator? Is it likely that global GDP will grow at 12%? You got a numerator growing at 12% and a denominator that's growing at less than 10%. What does that mean? That the debt burden is going to continue to grow faster than your tax base. So you say to me, Foss, go and raise the tax rate. And I'll say, they've done that, and every time they do that, tax revenue actually declines because more of the economy goes underground. So there's a law of diminishing marginal returns on your tax base. Countries like the USA are running annual deficits of 8% of their GDP. Not only are they not keeping pace, if everything was fixed right now, they're increasing their debt burden by 8% of GDP to fund all these programs they can't otherwise pay for. Which means fiat currency is the error term. They need to continue to print fiat money to pay back the debt in the numerator. And guess what? In a debt spiral, debt never matures. It needs to roll over. So this concept that, 10-year treasuries just matured, they didn't mature. They issued new 10-year treasuries to pay for the old 10-year treasuries, plus they got to issue more. Well, eventually the only buyer is the central banks that can print money to make sure this debt spiral doesn't unravel. Hope that's pretty clear. I like to call it 11th grade math. So that's why I'm 100% certain that fiat money will continue to debase. And it's not a hard call, Jake. It has debased for the last 100 years as well. So it'll just continue the trend. But the math of it is it will accelerate because of these twin deficits. The twin deficits are typically called your fiscal deficit and your current account deficit. I don't need to get into the economics of it, but 100% certain fiat money will continue to debase. The 60-40 portfolio. I traded bonds my entire life. I called at under 1% US 10 years. I wrote a paper. It's the basis of me entering into the Bitcoin community. Why would you ever own sovereign debt at these rates? Oh, all the experts were out there. Don't worry, rates can go negative. Yeah, I know mathematically they can, but I also know things should have blown up, and they certainly did. In the UK, liability-driven investing caused pension plans to fail because they levered bond returns to turn a 2% return. They levered it 3 times to turn a 2% return into a 6% return. And guess what? They were down 40%. So picking up nickels in front of a steamroller is never a smart thing. But what has now happened is people are not taking into account the fiat debasement. So you're still highly likely to get your US Treasury debt repaid in 10 years if you lend to them today at 3.75%. But the value of the $100 you invest today is going to be worth far less in 10 years than it is today, right? That's the fiat debasement reality, even though you got 3.75% paid semi-annually over the next 10 years, plus you get your $100 back, but it's in new money that's less valuable than the old money. That's the mathematics of bond. There's no subjectivity to it. It's a different world. And the USA is the only global fiat that really matters. And I argue that Bitcoin can help the USA avoid default as well if they start putting Bitcoin on the balance sheet of the US Treasury. But that's a topic of another discussion.
In defending his choice of Bitcoin over other cryptocurrencies, Foss highlights Bitcoin's first-mover advantage and its robust security ensured by the strongest computer network globally. He emphasizes the significance of Bitcoin's fixed supply of 21 million coins, which adds to its scarcity and strengthens its value proposition. In contrast, Foss dismisses other cryptocurrencies with smaller supplies, stating that the security of the network is essential for any digital asset to maintain its value and credibility. Bitcoin's status as the most secure digital asset makes it the best choice to protect against the potential devaluation of fiat currencies. Foss's analysis encourages investors to consider adding Bitcoin to their portfolios, seeing it as a hedge against fiat inflation and an essential component in a well-diversified investment strategy. By leveraging his credit background and mathematical models, Foss presents a compelling case for Bitcoin's investment potential and the importance of evaluating cryptocurrencies based on their intrinsic value and security features. What do you think about the latest interview with Greg Foss? And what are your thoughts on his insights regarding Bitcoin, investing, and the crypto market? Comment down below. Thanks so much for watching. Don't forget to hit the like button and subscribe for more content just like this. We'll see you in the next video.